It's times like this when you should be getting really excited about the looming opportunities. My name's Gary Davis, and these are the sort of times that I live for. 2020 was my best year ever. I stepped back early, cashed up, and took advantage of the great opportunities. And I was able to do that and help members do that as well, because I know what signs to look for, both in the turn down in the markets and also the turn back up again in the markets. And 2022 is setting up quite similarly in many ways, where quality growth stocks are getting cheaper. And when you add that to the extreme probability surrounding the megatrends that are unfolding, it really does stack the odds in your favour. So what's coming in this video? Psychology forms just such a critical part of taking advantage of these sort of opportunities in the market. So I want to look at why we make poor decisions in times of stress and how can we do it better. But most importantly, what can we do to regain the lost ground that would have occurred, I'm sure, in the first couple of months of this year, and forge ahead again quickly as we were able to do in 2020? What is the process? What are the steps that you need to go through? I'm going to be showing some examples from 2020 and also from 2018. And we'll be looking at some of the elements of what the turn actually looks like. There's the licensing information, and just a reminder that this is general advice in this video. All right, let's look at the process of managing your psychology. When prices fall sharply in big corrections, and we're certainly at the start of what could be a larger correction, it creates opportunities that just don't come along very often to make profits far more quickly than normal and often far more reliably than normal. It allows one to rapidly regain the losses that I guess happen in the early stages, because no one has a crystal ball for getting out at the exact top of the market. But you can certainly regain that lost ground and forge on quite readily. But the problem is that whilst we know it intuitively that buying after a significant correction, immediately after, while we know that works intuitively, it just feels a lot more comfortable to give into our emotions and just think like everybody else. That's the easy thing to do. Corrections are uncomfortable, and so we like to do things to move away from them, reduce the pain. And we end up in a bit of a deer in the headlights kind of situation. Your mind's in a turmoil. You don't know whether to hold. You don't know whether to sell. You don't know whether to buy. There's all these mixed emotions flying around your head. And it really is quite difficult to find the necessary resolve to pull the right levers. So whilst it's very obvious in hindsight what we should do, it's not all that easy to actually execute it. So if you've been following along what I've been doing in the weekend videos since the middle of December, you should be positioned fairly effectively by now. You should have reduced some exposure, which would have softened the blow in January and February. And that creates quite a significant amount of attack capital for when the rebound is due to occur. And the rebound is not a single date. Some stocks are starting to rebound and trend higher already. But there's a general period where the market does start to turn around and plenty of opportunities become obvious. And you've just got to have the capital to take advantage of that. So in getting prepared, psychology is just so critical. You really need a sharp focus on what the market's doing when the time comes. You can't afford to have your mind in a turmoil. And there are multiple things that you can do to assist with that. First of all, if you're the habit of looking at the bottom line of your account every day or multiple times a day, then you just got to stop doing that immediately, because it serves absolutely no purpose other than to mess up your mind. So there's certainly things that you can do. You need to get very clear on the broad composition of what you want your portfolio to look like in 3 months, 6 months, or by the end of the year. And it's not difficult to do. It's just some clear thinking about what are the sort of stocks that you want to own, and then what are the sort of prices that offer a good opportunity. As I said at the start, megatrends offer the opportunity to get into stocks that have got significant tailwinds. And so therefore, over time, the growth of the business and the growth in earnings is going to manifest itself. So identify the megatrends, identify the specific stocks within those megatrends that should do well, and then have an understanding of what the entry signals look like. So none of this is particularly difficult stuff to do. So some of the megatrends, decarbonisation, obviously, it's what the whole world is focused on at the moment. Battery materials leading the way with copper and nickel and lithium, graphite, etc. But we've also got a number of other elements in let's call it environmental advancement, if you like, that go into numerous different areas that have got a tremendous amount of social impact behind them. Another area, or in fact multiple areas, is really in digital technology, which includes things like cloud computing, artificial intelligence, robotics, cybersecurity, the list goes on. And then in healthcare technology, we've got amazing advancements being made in genetics. Telehealth is big. There's a number of areas. So they're just some of the megatrend areas that stack the odds in your favour very significantly. All right, let's have a look at what happened in the COVID crash. So the low occurred on the 23rd of March 2020. The peak was on the 19th of February, so it only took 5 weeks for the market to drop 40%. But the interesting thing is, and it happens all the time, is that the media was absolutely screaming disaster at the exact lows. They didn't do it up here, and they didn't do it here, but they were doing it here at the exact lows, and it happens every single time. So let's have a look at some of the commentary that was in the media at that time. This is CNBC, 23rd of March 2020, more losses ahead. Stocks sink as virus bill stalls. Markets in turmoil on the same day. Turning to the Australian Financial Review, looking locally, and the headline was "Hell is Coming." Billionaire Bill Ackman sent share market spiralling. Bear in mind, this is just 1 or 2 days before the absolute low. Another from the Financial Review on the 20th of March, US equity bearishness reaches 7-year high, and that's what happens at the lows. The bearishness is at its maximum level. People aren't bullish, they're scared. So the US equity market reset has put individual American investors on the defensive amid a bleak outlook for US stocks. Bearish sentiment, expectations that stock prices will fall over the next 6 months. And that was virtually the day before the lows. If we go back to 2018, where we had a 3-month decline in the market through October, November, December that culminated on the 21st of December. Again, this was CNBC. NASDAQ re-enters bear market territory. The worst 4-day losing streak for the major averages. And in the Financial Review, the NASDAQ tumbles into a bear market. And Australia's market is poised to extend the losses on the 24th of December 2018. So it's no wonder that investors have a hard time seeing the opportunities. And that's what this video is about. It's when we get to a significant low in this correction or cyclical bear market, the media is going to be screaming at you that the worst is yet to come. And it's very difficult to pull the trigger unless you're very organised and you've got some assistance in doing it. So let's take a look at some slides. This is FMG, Fortescue. The index low was the 21st of March in 2020. But FMG didn't fall at all during the COVID crash. It actually went up. And a few days after the low, in fact, the price was rising before the lows. And it rose from around $9.50, and it wasn't that much later. It was only January of 2021. The stock was trading at $26, almost 3 times the price. So what members of Portfolio Analyst and the Insiders Club were able to do in 2020 as things unfolded, and it was a pretty scary period. We all got caught out. There's no question about that because we were blindsided by COVID. But because of the signs that were pretty obvious in the market, members cashed up quickly and significantly, and that made life far less stressful for everybody because, yes, the market was still going down, but everyone had less exposure to it. And then once we started to see the turn-up signs, then we started to pick off the opportunities as those signals confirmed it. And that allowed the losses that we had in February and March to be recouped pretty quickly. Now, it requires confidence from first of all, having a plan, having realistic perspective on the market, not being led by the nose, by what the media is telling you or by what the voices in your head are telling you, and having high probability targets lined up. So that's the process. You get out of the way quickly, you have a realistic perspective, you shut out the media, you have your high probability targets in mind, you've got a rough idea of what the entry prices look like, and you just sit back and wait and just play it calmly. BHP, from the low in March of 2020, doubled over the next 4 months. It was the best time to make money in stocks like BHP. And the megatrend sectors are especially great because they've got added tailwinds. And whether we've got a war in Ukraine or we've got an economic recession or whatever we might have, these megatrends are going to continue. And these megatrends are definitely in play again right now. And you can just see that from BHP. Yes, the price fell very, very sharply when the iron ore price fell, but that turned out to be temporary. And the price of BHP and Rio has rebounded very, very strongly and are not far off their all-time highs. So they're not experiencing a bear market. If we look at a stock like Iluka, and none of these are recommendations, they're merely examples to show you what happened coming out of the COVID crash lows. So rather than be fearful, there were amazing opportunities. The crash low for Iluka was $3.30. It's now trading at nearly $11. And I'm tracking literally dozens and dozens of these in Australia and equally a similar number in America. Some of them are entries right now. Some of them will be entries unfolding over the next couple of months. Let's look at Apple. The crash low was less than $60. Apple reached a high in December last year of $180. That's 300% rise. And whilst it looks so blindingly obvious in hindsight, for the reasons that I outlined earlier, it's actually difficult to see it and respond to it at the time because your fear gauge is pretty high. You're probably listening to what everybody else is saying and their opinions. So the question is, can you pull the trigger? And have you played this sort of period well in the past? So they're things that you should think about. Let's look at Blackstone, financial stock in the States. The crash low was $33. We're now trading at $125. If we look at Chalice in Australia, this is definitely not a recommendation to buy now, but the crash low, Chalice was trading at 30 cents. Now it's trading at $8, having been above $10. So just consider what even a modest portion in something like this could do for your portfolio. And there are numerous potentials out there that could be another Chalice or even something remotely like it. The decarbonisation theme is going to unearth more examples like Chalice. And there's no doubt that big corrections are followed by big gains. Now, this is certainly one that you wouldn't want to be in now, but the ARC funds had a crash low of $40, and then by February 2021, so 12 months later, it was trading at $160, a 400% gain. You just need to know what the market is going to focus on, where the money flows are going to go, and understand what the turn looks like so that you've got the confidence to pull the trigger. This is not a difficult process, but most people are going to need some guidance with it. Now, I just want to touch quickly on what it was that I saw in December of last year that started turning me cautious and then even more cautious in January. So this is the spread chart, and anyone that watches the Sunday videos that I've been doing for years and years will recognise these charts. This is the ratio between consumer discretionary and consumer staples. When the line is falling, it means the market is bearish, it's defensive, and money is flowing into the staples area and out of the consumer discretionary area. So this was the middle of December. This was a breakdown. I saw that this was significant. We then had a bit of a blip, and then it really dropped into a downtrend. So that then confirmed it. So that was the initial sign. January and February confirmed it, and we now clearly have a downtrend. This is large cap growth versus large cap value stocks, and probably includes mid caps as well. The same thing. This is mid-December. The chart started behaving differently. So it was just observe and respond. Have an open mind about what the market is saying. And in addition to this ratio chart, there were just so many US stock charts, large caps, that were in severe downtrend because of this multiple contraction process that started in December. So what was clear is in mid-December that we had a very significant shift in sentiment, and that just got reaffirmed in January and again in February. WCLD is another ETF that I was watching very closely that showed me that the market internals were breaking down and that small and mid-cap stocks were rolling over as well. This is the mid-December period, and we've just continued to form lower highs and lower lows. And if we look at XRT, broke very, very important support in the middle of December. The consumer is 70% of the US economy. When this ETF broke that support, I knew that something was changing significantly in the market. You had to have your mind open to it. And finally, growth stocks looked very suspect in mid-December. They started breaking this support. So this whole process is really just about observe and respond. It's not about having a crystal ball. It's not about having a guess. It's not tuning into CNBC to see what sort of pearls of wisdom you can gather, because we've seen from the previous slides they're going to be absolutely wrong at the extremes. So the road ahead, the key here, if you're set up well, is actually being able to pull the trigger when the time comes. And most traders, in my experience, and I've been doing this many, many decades, most traders need reinforcement. They need perspective on the market. They need to get a different perspective to what the media is peddling. And nearly everyone who's got a career, got families, got busy lives, don't have the time to do what I do. And so therefore they need the what and the when. What stocks to buy? What are the high probability stocks? What are the megatrend stocks that are going to offer the best opportunity? And when should we be buying them? And what do the signs look like? More importantly. So let's have a quick look at that. So again, coming back to these spread charts, it's a combination of these charts that I show on a Sunday. It's the weight of evidence of not just looking at one chart or a couple of charts. It's looking at many, many things that show us where the money flows are going. And at the moment, the money flows are going defensively. There will be clear signs when the money flow reverses and starts going back into the growth areas. Other indicators that I use, obviously the VIX index is a key one. When the VIX really spikes hard and fear is at its maximum, is generally pretty close to the lows. There'll be quite a few individual reversals in major stocks. Stocks like Apple and Microsoft will be flashing signals that they're turning. There'll obviously be a high level of fear and bearishness, and if you want to watch CNBC or read the press, then that might work as well, as long as you do exactly the opposite to what they're telling you. And the other thing that I've observed over the years is that bad news stops being penalised. And invariably, markets are going down for a reason. And generally, when you get to the bottom, the bad news is being trumpeted the loudest, but the market stops responding badly to it. Then there are other areas, of course, the options market. There's plenty of information in the options market that can tell you when sentiment has reached an extreme and is starting to turn the other way. The behaviour in the bond market has another whole raft of signals that I watch. So the essence of the message here is the turn up is going to be as obvious as the turn down for those that know what signs to look for. That's the key message that I want to get across here. So there's still time to take advantage. If you want perspective, if you want recommendations, and you want some guidance to take advantage of what is almost certainly going to unfold in 2022, then you can join the Portfolio Analyst trial. It's $1 for 2 weeks. Gives you access to over 250 hours of episodes of learning, of strategy, of general skills development. It's a weekly service, so it may miss some of the early sharp moves, but it's a good place to start to get a better grounding on what the market is actually doing and where the opportunities are arising. If you want more, there's the Insiders Club, which is daily recommendations and analysis. It's where all my highest conviction stocks are, and they're being examined and commented on a daily basis. And I expect to do very well out of a spread of these because I've done it in the past. And I'm sure the same thing. If you stay focused on the megatrend areas, then similar things are going to unfold this time around as well. So the bottom line is, and this is something that a lot of people forget when we get fearful about the market, after a major correction is when the highest percentage returns are made. You just got to think about the mathematics. If a stock price is halved, then the percentage gains are obviously going to be bigger. Also, the downside risk is limited. If a stock has just fallen in half and it's a quality stock and the price is going to be justified to go back up again, then the downside risk is limited. Also, the probability of success is the highest. So, every single thing that you would want to occur together happens after a major correction. Now, members of Portfolio Analyst and the Insiders Club positioned to take advantage of this. If you're overexposed, it's not too late to adjust and take advantage. If you're still fully invested and don't have much cash, then you can still do something about it. It's possible that this market still has several months yet to go to the downside. I don't know, but I know what the turns look like. So why not take a look for $1? It's well worth it. It's times like this where the real money gets made.